is going to show us how the emotional separation with investing works with dollar cost averaging. At the very beginning, prices move up and down, and it's all very volatile, and it's making us feel feelings, which is a natural thing. However, you can see that over time, the longer that we deploy the dollar cost averaging strategy for, that the natural volatility of the portfolio kind of decreases over time, and you approach the long-term annual return that's expected from those examples. Obviously, in this example here, we have stocks, US bonds, and Vanguard Star Fund. These aren't Bitcoin examples, but they're classic examples from the stock market that I like to use. And I think that shows nicely how the longer that you run a strategy like this for, the more your average returns kind of calm down and kind of approach the natural average of the overall market. If you don't fully understand this, I understand. To me, this is quite sublime, and I really appreciated this. This is one of the most important investing charts for me when I was first learning, because it made me understand that when you're starting a portfolio, you have a lot of the highest behavioral risk at the very beginning, because you are looking backwards in time and your portfolio balance is going up and down like crazy. But as you put more and more money into the market, as you dollar cost average in, as you accumulate this position, the volatility of your entire portfolio as a function of the amount of money you put in, it slowly kind of calms down over time, and it becomes less likely that you ever go back into a drawdown again, and more likely that you receive the average return of that asset class. I know it's all very well and complicated. We'll explore this more in the masterclass, but we'll keep moving on. And the third benefit that we have with dollar cost averaging as well is, of course, the time efficiency. I've already mentioned how it is a time efficient strategy, and this really comes from its simplicity. You simply decide what frequency you're going to deploy, and you decide how much, and then you simply never stop buying. You just keep going and going and going, whether the price is high, whether the price is low. The idea is that we don't know when the price is high and when the price is low, but the average accumulation of our purchases will add up over time to a lower overall price, which benefits us. So you can see, if you're a time-constrained individual, this strategy is probably going to be best for you, especially if you're a long-term investor. So to quickly summarize so far, what we really have here with the dollar cost averaging strategy is just the fact that it is the granddaddy of all long-term strategies, and it is objectively the correct strategy to deploy under situations of imperfect information, which the market really is in a constant state of. So by definition, if you are in the market and you don't have perfect vision into what's about to happen, if you have a suboptimal process, if you don't believe that you have an unfair advantage, essentially, then dollar cost averaging is the objectively correct strategy to use for an individual. So what about the downsides of dollar cost averaging? So one of the main disadvantages of dollar cost averaging versus something called lump sum investing is that lump sum investing, where you instantly deploy all of your money into the market, has shown in research to actually beat dollar cost averaging over the long run because of its aggressiveness. If you look at the chart on the screen right now, what you can see is that the lump sum investing example with this stock portfolio did, as a matter of fact, outperform dollar cost averaging. However, you can see that the main disadvantage of lump sum investing is that it took the portfolio many years to break even again before it started seeing profits again, whereas the dollar cost average example was never really in drawdown to start with. It was always at a very low level and had a decent amount of performance later on in its life, despite not having the massive drawdowns earlier on. So this feeds back into the idea that dollar cost averaging is a fantastic method of actually accumulating an asset without having to worry so much about the volatility of that same asset when you're beginning your strategy. If you have a lump sum and you invest at the top of the market and it takes you years to break even again, it's very likely that you're going to make some sort of a mistake. You're going to be feeling very uncomfortable. You need to be thinking about your psychological state during this time and whether or not it would be worth the extra performance just to dump all of your money in randomly when you feel like maybe you're feeling FOMO. These are the considerations that you need to worry about. Personally, I believe that Neither of these are necessarily correct. However, like lump sum investing versus dollar cost averaging, however, I do believe that dollar cost averaging is still the superior method. There are a couple of different considerations that you need to think about as well when it comes to dollar cost averaging and its downsides. One of the downsides of dollar cost averaging is its lack of capital efficiency. By design, you have a lot of money on the sidelines ready to go, and you're kind of like drip feeding that into your portfolio by buying assets. This is if you have a lot of money already accumulated. If you've got a savings account with a lot of cash in it, you'll be finding that that money will be sitting there while you're deploying this strategy, and you're drip feeding the money into the markets, but that cash is sitting there doing nothing. Another example of a downside of dollar cost averaging is when you're in a raging bull market. If you're in a bull market, you can see how the lump sum investing example would actually be the superior choice, because you would be, instead of just buying a little bit as prices are going up, you would be buying the most when it's as cheap as possible and then making a huge amount of gains. Now, whether or not you can perfectly predict whether or not you're in a bull market or not, that's to be seen. We, of course, cover more techniques like this in the masterclass. But yeah, these are considerations that you need to make, and this kind of ties into my third point, which is that dollar cost averaging doesn't take advantage of special opportunities by design, by default. So if you have an area of value and your price is going sideways like this, and you're accumulating, and then you have a sudden dip, the dollar cost averaging method is going to tell you to buy a fixed amount, just like you were over here, that same fixed amount down here. Potentially, you might want to double, triple, or maybe 10x that amount and put in a huge amount down here so that by the time it comes back up again, you can say I've taken advantage of that special opportunity, depending on the amounts of research that you're doing. So this is another consideration. As you can see on the screen, there are zones that we can clearly define in hindsight that you could say to yourself, well, these are areas where I would want to take advantage of special opportunities. This is where you would want to dollar cost average less and dollar cost average more in order to take advantage of special and unique prices. So in summary, dollar cost averaging is the most accurate, most behavioral controlled, and the most time efficient method of doing long-term investing. It's important to note that there are no hard and fast rules with dollar cost averaging. You can buy every week, you can buy every month, you can buy bi-weekly or fortnightly, whatever is appealing to you, and there are no fixed rules. Also, because there are no fixed rules, this means the method can be modified to take advantage of special opportunities. Extra information and tactics and strategies can actually be combined with the dollar cost averaging technique in order to make it incredibly powerful. These techniques and these modifications will be covered in the investing masterclass. And with that being said, thank you very much for listening. I'll talk to you in the next one.